Good afternoon, everybody. We'll just chill till 3:15 to see if more people will join. So at 3:15 we kick off.
All right, sir.
Yes, boss. Hello, good afternoon, everyone. It's 3:11 by 3:15 in 4 minutes time. Would kick off. We'll just wait a little for others to join. So we have been waiting since 3 p.m. So wait 3 more minutes and we hit the ground running. Thank you. Hello, good afternoon, everyone. If you are with us, just wave your hands. You would have said if we can see each other face to face. But considering that we're using Zoom, just wave your hands. Okay, I think we should just go ahead. So yesterday we commenced our revision and recap of what we learned previously early this year on analysis and interpretation of financial statements. We did a recap of the ratios in each of the categories for profitability, for financial position, and the investor ratios. We also reminded ourselves about the three important questions, the three important things you must put at the back of your mind to carry out an informed analysis. Number one is to know what the ratio means. Number two is to understand the meaning of a change in the ratio. That's like the implication of the change in the ratio. And number three is to know the cause of the change. As much as possible, if you can include all three things, all these three stuffs I mentioned in your analysis, you would be home and dry. Your analysis will be as detailed as possible and would make more sense. Yesterday, we solved an ICANN pass question, I think November 2016, and we were able to analyze the profitability, that's performance, the stability and liquidity of a named company. Today, we'll be looking at we'll take one more step. The question to be solved today will be a little complex than what we did yesterday. The question has been shared on the WhatsApp group, so you can just download it, but you can follow through because I will also share the question here. So I have the question projected. As with yesterday, I will be making use of Microsoft Excel to solve the question. That is to compute the ratios and the analysis. Instead of yesterday where I typed the analysis, the analysis already pre-typed. So we'll just have discussions around them instead of typing again. That will make more sense. So here is the question. All figures are assumed correct from the beginning. Then here is the additional information. So we'll just take 4 minutes to read through the question, and at 3:23, we kick off with solving the question. 4 minutes. So it's 3:19. So at 3:23, we kick off with solving the question. So if you are reading through the screen as shared, just let me know when you want me to scroll up or scroll down, and I will just do that. I'll execute. Your boy is here with you. Okay, I've shared it. Okay, I will share it again now. Okay, Samuel has shared it already. So if I can you see the question now? Have you seen the question from the WhatsApp group?
Yes, I can now.
But can you see the question from my screen? I'm actually
I can't see anything from your screen.
Wow.
It's just blank.
It's blank.
I think you have to select which particular screen to
I actually did. Let me stop share and I actually did. Okay. So can you see it now?
Okay, yes.
Okay. So this is the question from the beginning. It's assumed that all figures are correct. So this is the additional information. So just let me know if you want me to scroll up or scroll down. We'll take like 3 minutes to read through it and we kick off. Better still, Madam Agada, if you are with us, can you please read it? So we listen to you while you read it. From this, the following information is available. Is Agada available? Can you hear me?
Yes, I'm trying to snap this so I can.
Okay. So once you can, just read it out for the class to listen to you and follow you through while you read. We are waiting for you.
For who? Just go ahead.
Okay, no problem then. I'll read. The following information is available. Additional information 1. On 1st January 2014, Wood Bank purchased the trading assets and operations of Shaw for $50 million, supposed to be Naira anyway, and on the same date, issued 10% loan note to finance the purchase. Shaw was an unincorporated entity and its result for 3 months from 1st January 2014 to 31st March 2014. And net assets, including goodwill not subject to any impairment, are included in Wood Bank's financial statement for the year ended 31st March 2014. There were no purchases or sales of non-current assets during the year ended 31st March 2014. Extract of the results for 3 months of the previously separate business of Shaw, which are included in Wood Bank's statement of profit or loss for the year ended 31 March 2014 are so all okay. The results, we will see it in the Excel sheet. So these are ratios, equivalent ratios that have been computed for 2013. So required, calculate for the year ended 31st March 2014, equivalent ratios, all 6 to the above, for Wood Bank based on its reported figures. Equivalent ratios to the first 4 only for Wood Bank, excluding the effects of the purchase of Shaw. Note, assume the capital employed for Shaw is equal to its purchase price of $50 million. That's 10 marks. B, assess the comparative financial performance and position of Wood Bank for the year ended 31st March 2014. Your answer should refer to the effect of the purchase of Shaw, 15 marks only. So I will just take us to the Excel sheet. So what has happened basically in the question is that, of course, there is an entity, Wood Bank, and during the year, 9 months into its year, the company acquired another company referred to as Shaw. So the requirement is simple. All these ratios have been computed for the prior year. So they require us to compute the ratio for 2014, which is the current year, by taking into consideration what has been reported above, and also excluding the effect of the purchase of the new company Shaw. One good thing about analysis, or one important thing about analysis, is that when comparing between 2 periods or 2 standards or 2 points, it's important to find out what is a one-off item. That one-off item is expected to be analyzed, the whole the company in question is expected to be analyzed by excluding that one-off item. So we'll see the impact of that one-off item, and we'll also see if the one-off item had actually happened. So it's like saying, what if it didn't happen? How will the results look like? And now that it has happened, how is the result appearing? Please let's mute our mic. So how is the result appearing? So we'll just move into the Excel sheet to first start with the computation of these ratios. Then we'll talk about assessment of the financial performance and position of Woodbank.
We see a significant amount of people having this kind of enthusiasm about strong and populist or right-wing populist. There's also this element.
So like we did yesterday, here is the profit or loss of Woodbank. And just underneath, we have the statement of financial position of Woodbank. We also have the results of Shaw. And we also have the ratios from prior period. So we can just move to the top. By this side, we'll make it an appendix like we did yesterday, or we call it workings. So the first is A.
Sorry, sir.
Yes, Agadamutim.
I cannot see the screen. It's just the same page you showed before that is still there.
Okay.
Oh.
So, can you see the Excel document now?
Yes.
Okay. So that means you have to help me with what you can see in the PDF. So what is the first requirement?
Revenue is there.
No, first requirement 1.
Calculate. Okay, let me call it.
Calculate equivalent ratios.
Okay. All right, equivalent ratios.
Yeah.
So what we'll just do to make it easier for us, so we'll say 2015 ratios, including the effect of Shaw. I would also say 2015 ratios excluding the effect of Shaw, so that we can have it side by side. And we'll also have the prior year ratio, which is 2014 ratios. Don't forget that these 2014 ratios have already been computed in the question. So, who is there? Agada, please help us. I know the first ratio is return on capital employed. So I'll type that out. After the return on capital employed, what is the next ratio we are to compute?
Next.
You said net assets.
Over.
Okay, let's just start with return on capital employed. As with yesterday, you will be helping me with the formulas to help those of us who don't know the formulas, people like myself talking. I want to learn from you. So what is the formula for return on capital employed?
Profits before interest and tax all over Capital employed.
divided by capital employed
Times 100.
times 100. So that's the formula. So if we consider including the effect of Shaw, recall, the effect of Shaw is already in this 2015 results. So I will just go in and remember, profit before interest and tax, that's PBT, is profit before tax plus the interest expense plus interest expense. We did something like this yesterday. So PBT is equal to so my people, what is the profit before tax here in 2015?
27,900.
So the profit before tax is 27,900.
Yeah.
What is the interest? Because we have to add back that interest. That's 500. That means the profit before interest and tax is 28,400. Capital employed, on the other hand, the question gave us an hint on how we should calculate the capital employed. What was the formula stated in the question? There was a formula stated in the question for capital employed.
The 50 million?
No. You know, we are trying to calculate capital employed for Wood Bank. The 50 million is when you are calculating the return on capital employed for sure as a company standalone. So that 50 million is not for Wood Bank. It's for calculating the return on capital employed for sure as a standalone company. So there, if you look downward, you will see each of those formulas. So there's somewhere they stated capital employed is equal to, I think, total asset minus current liability. That is the formula stated in the question. It will still amount to the same result of adding your, like we did yesterday, adding your equity and your debt. Remember that deferred tax should not be part of your capital employed because it's not a debt, neither is it equity.
Mm-hmm. Okay.
So if we go by that, so we say total asset minus our current liability. So I will just go and look for my total assets. Total asset is 175,000 minus my current liability. Current liability is 25,000. So that means my capital employed is 150,000. So from there, I can get my capital employed, and my return on capital employed, convert it to percentage, and I have my 19%. So for 2015, including the effect of Shaw, the return on capital employed is 19%. Let us calculate the same, assuming Shaw was not acquired. So first, assuming Shaw was not acquired, the question is, how much would have been the profit before interest and tax? So I go down here to find out how much profit is Shaw contributing to the whole thing. So look at Shaw's result here. So down below, we have Shaw's results separately stated. If I add this up, so Shaw contributed 5,000 worth of profit in the current year. So that means assuming they did not acquire Shaw, the profit would have been 28,400 minus 5,000, which was contributed by Shaw. Oops, the profit would have been 23,400. We do the same thing to the capital employed. Assuming Shaw was not acquired, how much would the capital employed be? That's the next question. Let me throw it to the floor to tease as a brain teaser. So let me see who's in the room. Mr. Yusuf Abdullahi, how much would be the capital employed assuming Shaw was not acquired? Given that the capital employed because Shaw was acquired was 150, then how much will it be if Shaw was not acquired? Can you help us with that?
No, sir. For now, I can't say anything. Just bringing myself into
Okay.
see if I can get one or two things from it.
Okay. Okay.
Yes,
All right. So this capital employed, including the effect of Shaw, is 150. If you recall from the requirement, it was stated there that assuming the capital employed relating to Shaw is 50,000. So that means it should be 150 minus 50, which is the amount of capital employed arising from the acquisition of Shaw. So from there, we have the return on capital employed if Shaw was not acquired. It appears that Shaw came to cover them, because if it was not acquired, the return on capital employed will be higher than it's looking. When we get to the analysis, we'll see more of that. So in 2014, please, someone should help me. What was the ratio of the return on capital employed for 2014? It's stated in the question.
%10.5%.
You said?
10.5%.
10.5%. So we have that for 2014. So we can see the three ratios at a glance. That is for return on capital employed. After the return on capital employed, what is the next ratio to be computed based on the question?
Net assets turnover.
Net assets turnover. My people, help me with the formula. Help me with the formula. I think the formula, a hint about the formula was stated in the question. But please, I throw it to the floor. What is the formula for net asset turnover? Any idea? Madam Agada, Ifeanyi, Matthew, Mr. Yusuf.
It should be, okay.
Over assets.
Okay, you know yesterday we did total asset turnover. Now this is net asset turnover. So it's sales over net assets. However, if you check the question said we should take net assets as capital employed. Therefore, the formula would now be sales over capital employed. Yesterday was total asset turnover. So we did sales over total assets. Recall, the meaning of the ratio is that it evaluates or shows you how the company is making use of its resources to generate sales. And it's more of a higher the better ratio. So it's sales divided by capital employed. So we go again. The sales for 2015 is 110,000. The capital employed for 2015, we have calculated it here before, is 150,000. And these ratios, these two are based on the fact that Shaw was acquired during the year. So it's 0.73 times for 2015. So we have to calculate for 2015. Oh, sorry, the Excel document just closed. Oh, the Excel document just closed all of a sudden. I think we have completed this to be this minus 1, 2, 3, 4, 50,000. And this was computed to be 10.5%. So we're at the verge of calculating the net asset turnover. And we have established that it's sales divided by capital employed. So the sales for 2015 is 110. The capital employed for 2015 is 150. Calculation of that will give rise to 0.73 times. Now, how will the net asset turnover look? Sorry, the Excel document just, I don't know why it crashed. So we stopped at the net asset turnover. So for 2015, it was 0.73 times. I hope we can see my screen. Ifeanyi and everybody together.
Yes, sir.
I hope it, yes, the Excel
Yes.
screen. All right, thank you. So the 2015 ratios, we have to exclude, in the next area, we have to exclude the effect of acquisition of Shaw. So it is this 110. How much was Shaw's revenue? How much revenue did Shaw contribute? Someone should, okay, it's down here. I didn't include it in the question. It's down here. Shaw contributed 30,000. So if yeah, the Excel of yesterday, you will know observe that it's the same Excel I'm using. So I just want to share it once and for all. That's why I haven't shared it yet. So the capital employed, assuming Shaw was not acquired, we also remove the 50,000. From here, we can calculate the asset turnover. Please assist me. How much was the asset turnover for 2014?
1.16 times.
What did you say?
1.16 times.
1.16 times. Okay. So what is the next ratio?
Gross profit margin.
Gross profit margin.
Oh, sorry,
Okay.
sir. I have
Yes,
a
please go
question.
ahead.
Sorry, for the 30,000 and the removing fee, I didn't really know how you arrived at it. I'm sorry. For
Which
the
one?
shares revenue. Yes, that
Okay.
place now. Where did
Okay.
you pick it and how
Yeah,
did it
it's
happen?
here. I actually included it in the Excel document here, but I didn't copy to that document I shared with you. I will share an updated document after this class.
Okay,
So
okay,
it ought to be inside the question. Look at it here, this 30,000.
okay,
Because part of the question is to include how much Shaw has generated. And part of this amount that Shaw has generated is already inside these figures. It has been consolidated.
okay,
Yep. So for
okay,
sales, it's just 110 minus the 30,000 contributed by Shaw.
okay, okay,
And the
okay,
capital employed is 150,000 minus the 50,000 capital employed arising as a result of the acquisition of Shaw.
okay.
So
Thank you, sir.
after the net, yeah, thank you. After the net asset turnover, you said we have gross
Profit
profit
margin.
margin.
Yes.
Please help me with the formula.
Gross profits all over sales.
Gross profit divided by sales. So including Shaw's results, the gross profit, I can easily pick it here. That's 24,200. The sales, I already have it, is 110 here. And easily, I have my gross profit margin. Of course, it's gross profit divided by sales times 100% times 100%. So I can convert this to percentage and we have 20%. What does this ratio mean? Remember, for every 1 naira sale, the profit, the gross profit is 22 kobo. That's what this means. So for every 1 naira sales, the gross profit earned is 22 kobo. Let's see what would have happened assuming Shaw was not acquired. That means we have to remove from this 24,200 the amount contributed by Shaw. So it's 24,200 minus, let me just scroll down here and I pick up the amount contributed by Shaw, which is 9,000. Also, the sales is 110. Recall that Shaw contributed 30,000. So I removed that 30,000 contributed by Shaw. Again, I compute. So we have 19%. Interesting. So because of the acquisition of Shaw, their gross profit is higher than it's supposed to be. Please, how much was the gross profit in 2014?
22%.
72.
22%.
22%. After the gross profit margin, what next?
Profit before interest. Profit before interest and tax margin.
Profit before interest
Interest.
and tax margin. That's PBIT margin. Please, what is the formula for that?
Don't know.
What is the formula for profit before interest and tax margin?
So PBT over sales times 100.
So,
Thank you very much. So we'll say, okay, let me just abbreviate it. PBT PBT over sales times 100%.
yes.
So last year, 2015, the PBT we have calculated before, it's 28,400, including the result of
Interest.
Shaw. The sales, we already have it, is 150, 110. So from here, we can determine the PBT margin to be 25.8%. Now, we already calculated the PBT again up here when calculating capital employed. If Shaw was excluded, the profit before interest and tax would have been 23,400, and the sales would have been
100.
80,000. We have calculated it here before when we were calculating net asset turnover.
Yes.
So from here, we calculate our EBIT margin, and it ends up being 29.3%. So in 2014, how much was the PBT margin?
9.1%.
9.1%.
Yes.
Okay, Victor, please go ahead with your question. Victor, are you there? Please go ahead with your question. You can also type the question out if you are shy. Go ahead with your question, Victor.
Good afternoon. I don't know. I don't know where this question being solved was gotten from.
Okay, you can check it from the WhatsApp group. It has been sent to the WhatsApp group. Let me resend. Let me see if I can resend to the chat here. But if anyone has it, just please, anybody in the team can just share it. But I will just share it from here. So there you go. It's been shared.
Thank you.
So aside from profit before interest and tax, what's the next thing we are expected to calculate?
Current ratio.
Current ratio. Okay, what is the formula for that?
Current assets over current liability.
Current assets over current liabilities. So we can easily pick that from the SFP. The current assets for 2015 is 25,000,
Yes.
and the current liability for 2015 is 15. So we have it as 1.77%.
Okay.
We have it as 1.77%. So how much is the 2014 ratio, computed 2014 ratio?
1.7 to 1.
1.7 to 1. So we can't do the same for, I hope I'm picking the right figures. We will not be able to do the same. Let me check the question. So we can't do the same for Shaw because they didn't give us the information about Shaw's current assets. The information provided about strictly for the purpose of calculating the profitability ratios. I think I've been picking from the wrong column. Sorry, I'll just rectify that easily. Okay, it is 15 and 14. This is supposed to be 2013. So the profit before interest and tax should have been this minus this. So the profit before interest and tax here too should have been, let me just link it, this. So I'll fix for this one too as well.
Sorry, Mr. Ezra.
Yes.
You said that there is an extract profit and loss, right, for the acquired entity?
Yes, that question I've not. I would update the question and share the update with you.
Okay, just to be sure, the profit before interest and tax that we use for these 2014 ratios, including the effect of Shaw, is the profit before interest and tax reported in the P&L of Shaw. So I'm asking if we have the extract for the acquired entity and they have a profit before interest and tax, are we supposed to add that to this?
We're supposed to remove it. Look at what happened here. I have the extract somewhere down there. So what I did was to say this 18,000
minus that, okay,
minus the profit contributed by that. The profit contributed is 5,000.
Okay. And this is on the assumption that, this is on the assumption that the company was acquired first of January for 2014.
Yes. It was acquired during the year, like 3 months before the year end. That was when it was acquired.
Okay, so the assumption here is that the P&L prepared by that parent company that has acquired the other guy is representative of the full situation of both.
Exactly.
At the end of 31st.
Yes. Yes.
Okay.
It has been consolidated.
Okay.
Yep. So the sales, that's 150. Again, in this sales, we removed the sales contributed by Shaw to arrive at this. For the gross profit, we did the same. We removed the gross profit contributed by Shaw to arrive at that figure. Same thing for the sales. Profit before interest and tax margin as well. We have removed, in this column, we have removed all the effects contributed by Shaw. Then what we have in this column is only effects contributed by, both Shaw and Wood Bank together consolidated.
Okay. So sorry, why I asked that is the financials that you sent us it didn't expressly state it that it's a consolidated statement. It's not a consolidated P&L.
Okay.
So normally, if it's consolidated, they'll tell us, right?
Okay.
And if it's not consolidated, they'll just give us something like this, and maybe give us the actual results for the other party, and then allow us.
It was actually stated. If you look at additional information 1, it was stated that Shaw's results was included in the financial statement for the year ended. So let me just read that part. Shaw, that's additional information 1 on the 3rd line. Shaw was an unincorporated entity, and its results for 3 months from 1st January 2014 to 31st March 2014 and net assets are included in Wood Bank's financial statement.
Okay.
So it was stated in the question that anything relating to Shaw has been included.
Okay, thank you.
Yeah. So, any other question? It's fine then. So aside the current ratio, please, what is the next ratio to be computed?
Sharing.
Sharing. Yeah, the question, I will update the question and share with you. The Excel has the correct, the Excel document has the correct FS. I will send the updated PDF document to you. So we can just focus on the share and the figures in the PDF document. So the next thing is sharing. So what formula did they say we should use for sharing?
So debt over debt plus equity.
So they said we should use debt over debt
plus equity.
So we go pick our debt. Our debt for 2014 is 55,000. So say 55,000 plus our equity of 95,000. Of course, what we have here will be multiplied by 100%. So I have my calculator with me. So the sharing was 37%. So how much was it for prior year?
5.3.
5.3. 5.3%.
Yes.
Wow. That's a massive increase. It actually increases by so much. Now, aside from the gearing, what other ratio are we required to compute? Is that all?
Mm-hmm.
So what did the, okay, we have done everything once and for all, including and excluding. So here we are. We have computed ratios for return on capital employed. We have completed ratios for net asset turnover. We have completed gross profit margin, PBIT margin, and current ratio, as well as gearing ratio. It's time for us to analyze the ratio. Let me see, check the chat. Okay, Victor, I get your question. I said, what is equivalent ratio? If you look in the question, they've already calculated some ratios there. If you look in that question, you see that they've calculated some ratios there. Those ratios relate to 2013. Those ratios relate to the prior year. Let me put it that way. They relate to the prior year. So they want us to solve those same ratios for the current year, including the effect of acquisition of Shaw and excluding the effect of acquisition of Shaw. That is why we have created these two columns. So by equivalent ratio, they mean the ratios that they stated in the question up there. All right, thank you. My people, any other question? Okay, in the absence of zero question, let's analyze this thing together. Madam Agada,
Yes.
last year, the company had 10.5% worth of return on capital employed. This year, they have 12%. However, if they did not acquire Shaw, their ROCE would have been as much as 13%.
Okay.
The thing has been put in your hands, you are in the hall. Explain how you analyze this so that we who don't understand, we can understand it better. Your answer can be as simple as, I don't know.
I don't know.
Good. Point at somebody that will help you out.
Well, based on the return on capital employed.
Before you go ahead, remember those three things you must always take into consideration. One, what does the ratio mean? Two, what does a change? What is the implication of a change in the ratio? Three, what has caused the change?
Okay. Going by this ratio, return on capital employed, the ratio is talking about every 1 naira that is being invested, the money or the return that is able to generate. So based on the computation, the 2013 prior rate was lower than the current year, which is last year was 10.5%, and this year is 12%. Is also higher than 10.5.
Yes.
But going by the acquisition of Shaw, if the company did not acquire the Shaw, they would have also made a return of 13%, which should be higher than even what they have already made. Even though the 12% is higher than what they made before, acquiring this company still made their turnover to reduce by 1%.
Okay, nice. Thank you very much. So we can say it's the company that has caused it, but we need to drill down further again. Recall from our previous learnings at the beginning of the year, the return on capital employed is the primary ratio. In short, the first question we solved in class, after evaluating the primary ratio, we went on to say that when assessing the primary ratio, unlike what we did yesterday, you are still expected to see how the secondary ratios have impacted the primary ratio. So I don't know if, let me throw it to Matthew. Can you remember what the secondary ratios are as far as return on capital employed is concerned, your answer can be as simple as, I do not know. Matthew, over to you. Oh, Matthew is not around. Let's make use of Victor. Please help us. So what are the secondary ratios? Victor, we await your input. What are the secondary ratios? If return on capital employed is the primary ratio, what are the secondary ratios? Just a response from you and we are fine. I don't know is an answer.
I think the secondary ratios are PBIT margin.
Okay. Okay, we are with you. You can also just type them as a chart.
Okay.
Yeah, if your network, because we only had PBIT margin, what of the secondary ratio? There are two. Let me give you a clue.
Net assets.
Yep. So like you have said,
asset turnover.
Exactly. So the first secondary ratio is we have the asset turnover and we have the PBIT margin. Like you have rightly said, compared to prior year, the ROCE has improved. Fantastic, fine. In short, we can say that because of Shaw, the company's ROCE is the way it is. The company's ROCE should have been higher than that if they did not acquire Shaw. But let's drill down further again. Let's take care. What are the things that have caused the increment in this ROCE? Remember the two constituents of ROCE, asset turnover and PBIT margin. Take a look at it. First, asset turnover. Between 2013 to 2014, asset turnover reduced. That is including the effect of acquisition of Shaw. But ladies and gentlemen, surprisingly, if you exclude the acquisition of Shaw, not even surprisingly, the asset turnover too could have also been higher than it should be. Also, so that shows us that the increase in this ROCE is not from this asset turnover. That is the increase here that we have seen. The increase in ROCE is largely as a result of the increase in profit before interest and tax margin. So because the profit before interest and tax margin has increased, the ROCE was also able to increase to such an amount. We can also step further to ask ourselves again. Shaw as a standalone company, how much is their own ROCE? If you take Shaw as a standalone company, I will just put that here by the side. Shaw as a standalone company. According to the question, its profit before tax is 5,000. And the capital employed is 50,000. Shaw as a standalone company. Remember, it's 50,000 we spent to invest in Shaw. Now, to make the assessment more sensible, this profit before tax, this PBIT, if you read through the question, it was a 3-month profit before interest and tax. So it may be unfair to say that Shaw has spoiled the whole show for Wood Bank, because what we consolidated for Shaw was only 3 months. What if it makes this same profit every three months for a whole year? Assuming that means Shaw would have earned the profit of 20,000 in a full year. And as a standalone company, they have told us to assume that Shaw's capital employed is 50,000. So Shaw, as standing alone, has a ROCE of 40%. Interesting. So it was sweet to say that yes, Shaw has caused problem for them, fine. But don't forget, like we said earlier, that Shaw's contribution was just a 3-month contribution to profit. So it's unfair to say Shaw is the cause of the problem. To now drill down further, we now ask ourselves, okay, how much is Shaw's ROCE on a standalone basis? Assuming they earn the profit, assuming profit accrue evenly, Shaw would have generated the ROCE of at a whopping amount of 40%. So it may appear that it looks like the company knows what they were doing. That means in the future, a company like Shaw will generate more profit. Within 3 months, the company has generated 40% of ROCE. I mean, within 3 months, if you analyze the profit, it's 40%. That means the future holds positive and good tidings for them, with Shaw with them. But for now, without mincing our words, Shaw has actually contributed to a 12% ROCE instead of a 13% that they would have enjoyed. But it has prospect because on a standalone basis, it's 40%. People, any question before we move to the next ratio? So they said we'll talk about the profitability, which we have talked about largely. That's the return on capital employed. We have spoken about the asset turnover. The asset turnover would have been better off if not for the acquisition of Shaw. We have also spoken about the PBIT margin. The PBIT margin was higher. So in conclusion, profitability improved from prior year, but should have been better if Shaw was not acquired. But it would be unfair to say Shaw was the cause because Shaw has only been with the company for only 3 months. Whereas capital employed is a figure as at a point in time. It accumulates what has been happening over the years. So that is our conclusion for the profitability. And we also spoke that Shaw in the future with such, it will be able to generate more profit and even support the Wood Bank books profitability. My people, any question? Agada, any question?
Yeah, home and dry.
Victor, any question? So all these analyses, I've already documented them here. Instead of going to the rigor of typing like I did yesterday. The analysis have been documented here. The next thing is liquidity.
Sorry, can I ask a question?
Please
so
go ahead.
Based on this calculation on Shaw, the 40% assumably,
yes.
in exam purpose or in exams condition, are we going to, is this proper to analyze it this way in case you're trying to recommend that it has contributed a particular percentage, is not a bad market to acquire? Okay.
It will even make your analysis richer. It's fine.
Okay.
Yeah. Just to let them know that it's true that it may happening. It may be that Shaw has affected them, but it will be unfair because Shaw was just acquired 3 months ago.
Okay.
If we look at Shaw on a standalone, it can actually generate profits in the future.
Okay. Thank you.
Even more profitable than Wood Bank itself.
I agree. Thank you.
If any question?
No questions.
Right. So the next thing is liquidity. For liquidity, there is nothing like I bought Shaw, I did not buy Shaw, because they didn't give us the current asset and current liability figures for Shaw. So it's going to be current year versus prior year, straight up. In the current year, the current ratio was 1.1, and in prior year, it was 1.7. If this was left to you in the hall, What do you think is the cause of this decline? Remember, we talked about a range yesterday that current ratio is about 1.5 nowadays, between 1.5 to 2.1, but 2:1 used to be an old ratio. But 1.5 tends to be that benchmark. So in prior year, it was 1.7. It was higher than the arbitrary standard. But in current year, we have 1.1. It has fallen. It has dropped so much. What can be the possible cause based on what you can see in the question?
I don't want to thank you. I really do. Thank you so much. Thank you. Thank you. I'm so grateful. Thank you.
Thank you very much.
Wow. This is what I have.
Remember that when you are trying to find the cause, just look at the components. What was used
of each item? Yes.
Yeah.
Okay. So I'm looking at the component of current assets to know if it changed between the previous year and this year. And the figure that stands out to me is just the bank balance that reduced from 5,000 to 500. No. The dates in my PDF are off, so I'm assuming the 2015 is the 2013, right? So I'll take that to be a yes. I can't hear you.
Yes,
I'll take that.
Yes.
Okay. So there was a reduction of about 4,500 for the bank balance. What's that? I'm not sure how to analyze that the bank balance reduced by 4.5 million. So it could be a liquidity issue that I don't have enough cash at hand.
Okay.
Or trade receivables also increased, which means that funds that they were supposed to use to run the business, a greater portion of it is now with debtors. Also, they held more inventory, so they didn't sell off as much.
Okay.
So, at least from that, I'm trying to look at the value for the current assets. On the other hand, also there was a significant increase in payables. So, in my opinion, since the payables value is rising and the receivables value is also rising, it could be a credit policy issue for the company. I'm just saying. Okay, that's what I think. The reasons for the drop. Maybe they need to tighten their credit policy is not tight enough, leading to higher payables and higher receivables.
Okay, thank you. You have spoken well. So that we don't take too long on the analysis, we have seen that it has dropped. What is the major cause of that drop? No doubt about it, you have mentioned it, the drop in bank. For example, by how much did the bank drop? Let's see the percentage. Last year, bank was 5,000. This year, it is 500. The bank dropped by 90%. Ladies and gentlemen, that is the number one reason why we have a current ratio as low as this in the current year. What could have made the bank drop? This is not far-fetched as well. Remember that in the current year, they acquired a new subsidiary. So it could be that the acquisition of the new subsidiary was, of course, the acquisition of the new subsidiary was financed through debt. So it may not be the acquisition of the subsidiary. A lot of things can cause it. Maybe the company declared dividend during the year and they paid dividend. It's possible. Maybe as a result of the expansion that they are, because by acquiring that new subsidiary, that's an expansion plan. It's possible that they incurred more costs incidental to their expansion. As a result of all these things, they suffered the decline in their bank balance. We can take a look at the revenue. Even the revenue itself dropped. Of course, revenue is not cash, it's still accrual accounting. But one way or the other, if you sell more, you collect less. You collect more. If you sell less, you collect less. If all other things being equal. So like you rightly said, the drop in the current ratio is as a result of the bank, and the reduction in the bank can be tied to expansion-related issues within the company's group, and a possible declaration of dividend. Maybe they declared dividend during that period, so they had to set to this dividend. Let me move our sister. All right. So that's it for the current ratio. Yeah, you have a question. Please go ahead.
Okay, based on this current ratio, can it be that they bought so much inventory because their inventory increased more than what it was in the previous year? So
sure, that could be
can
another,
it be the factor?
Yeah, that could be another perspective. It could be that they bought more inventory, and the inventory they stay in store, so that you will see that their revenue also dropped. So less patronage compared to prior period. But if we still look at things, the drop in that bank is massive. 90%.
Yes.
Yeah, it's very comfortable to tie it to group reorganization costs or expansion strategy, which is being carried out by the company during the year. So if Shaw lives up to the expectation, there's a likelihood that in the future all these costs and all these outflows will be recouped if it is a good investment at the end of the day. So of course, what you mentioned can actually suffice and be used for explanation.
Thank you.
Any other contribution? Any other contribution? Okay. And finally, we have gearing. This is a no-brainer. Last year, gearing was 5.3%. This year, it has increased to 57%. Why won't it increase? Remember that they borrowed funds to acquire Shaw. So the increase in the gearing is because of that 50,000 amount, that fund that they went to go and borrow to acquire Shaw. The implication of this on the company is that they will be charging more interest in their income statement. However, if Shaw turns out to be good business, then those interests should be covered by the potential income that Shaw will bring to the table. Otherwise, a ratio like a profit before interest, fixed interest cover, like we saw yesterday, a ratio like that will be throwing up abnormal figures in the future. So if Shaw should continue with the current prospect that is showing in the future, the expectation is that the gearing will not have too much effect on the profit or loss of the company, because Shaw would have contributed a lot of income to cover the interest expense. But no doubt about it, this gearing, the increment is as a result of the borrowing, because last year they didn't have any borrowing, but this year they had to borrow to acquire Shaw. And that's the bulk of it. That was just 15 marks. Because this competition we have done is, I think, 10 marks, and the assessment we have done, which is the evaluation year, is just 15 marks. And that marks the end of the question. I don't need to type like I did yesterday. So, any question? Let me see the people on the call. Ifeanyi, any question? Victor, any question? Yusuf, any question?
Okay, Mr. Israel.
Yeah.
Yesterday we gave our analysis in the report format. I'm guessing that's because it was expressly requested for.
Exactly.
So if it's not expressly requested for, we just state it and explain. Okay, thank you.
Yep. Any question?
Please, I didn't hear what he just said.
You mean Ifeanyi? Ifeanyi, please
Yes, I
recap.
didn't hear
We
any
didn't hear you.
question.
He just contributed. He didn't ask any question. What he said was that, okay, fine, please, over to you.
I basically was asking for the format of the report cum analysis. Going by what we did yesterday, we adopted a report format in doing our analysis, and Mr. Israel has just confirmed that it is because he was strictly requested for in the question. If it isn't requested for, it's okay to just detail your analysis in a clear way, I guess.
Yeah, you can just follow the way I'll share this Excel document afterwards now. You can follow the way I've stated here. Just put the name of the company and the topic. That's like a subject. Analysis of an interpretation of Wood Bank financial statement or whatever. Then you do a little introduction and you kick off. That's allowed, it's fine. But if you are requested to write a memo, please give them memo. Even all those martial art are dealing with the memo from to subject, date, those things carry marks. The one you end with is signed financial reporting accountant. Remember, we also said yesterday that don't go and write your name, because writing your name in the memo is like trying to plead for favor. You don't know whether it's your uncle that will go and be marking your script. Before you know it, where it's supposed to give you a very good 0, is giving you 10 or 15. So don't go and implicate yourself. Just put a designation there and you are home and dry, you are fine. So I would want to stop at this point, but this is what I will do. I would share 2 more questions on the group, which I will implore our people to try their hands out on. And we can schedule for maybe 1 more class during the week. I don't know, when is the exam?
I think it's on 15th.
It's not 16th. 16th.
No, 15th.
15th. Okay, 15th. So I would like to share like 2 more questions with you guys, which I would suggest you try your hands on. Then sometime around Thursday or Friday, if it will be fine. I think everybody is working from home now. We can do an evening meet up, and not everybody. You are still going to the office, ne?
Not really.
Okay. So will Thursday evening be fine?
Yeah.
Thursday evening works
like
for
what
me.
time?
In the evening.
8
Maybe
p.m.
Is 8 p.m. fine?
Yes.
Okay.
Yes,
Do we
yes,
have
for me.
8 p.m. not too late. If it lasts for 2 hours, that would be like 10 p.m.
It's
as
still 10
in
o'clock.
Up
people
10
will be
p.m.
sleeping? Should we do 7 or 6?
We've been doing it
What
now
about
with Mr. Miwa.
7?
Yeah, let's do 7. I think you have been doing it with Mr. Muiwa now, right?
Yes, we've been doing 8 with Mr. Mewa. However,
8.
the important thing is that many people turn up. So if 7 works, it's fine by me too.
Okay. So let's strike a balance. Let's make it 7:30.
7.
Yeah, 7:30. Okay then. So I will share an updated version of the question we solved now. I will share 2 more questions before ahead of Thursday, and I plead with you, try your hands on them. You know, ratio analysis is a constant K. If you know it very well, it's a free mark question for you. It's 15 mark. You just play with your 15 mark and you walk away. And it's one of the most simplest aspects of this financial reporting. So please, whatever question I'll send, Try your hands on it. You don't know what the kind of spirit that led me to send that question. We can't see. So please try your hands on it.
Hope they will not test work back on ratio.
You said
Hope they will not test working back.
You don't want them to test it.
Well, maybe one of the questions you sent to us should be one of these workbacks so that we can review.
Okay, no
I love
problem then.
ratio, but that one is bad.
Okay, I will get the work back question and the normal ratio analysis question to send ahead. Just try your hands on it. While you are also solving it, if you stumble on any issue, please, you have my number. You can send me chat or send me, call me. If I miss your call, I miss your chat. Once I'm online and once I see your call. Okay, let me just type it in the chat. Yep.
Okay, Mr. Israel.
Yes,
I don't know, maybe you want to end the recording, but I just want to ask about group P&L. When are we doing that one?
Okay, you want revision on that one too?
I want revision on that one. No.
Okay.
Master sheet and the like.
That's private. I'm coming, me fine. So you can take my number 081.
Okay.
081 070 11 294.
Okay. Thank you.
081 070 11 294.
Yep. Thank you.
Okay. Yeah. If we can also do a time like this on Saturday next week for income statement, I hope that will be fine.
Yeah, that works for me. So we are assuming Saturday next week at about the same time would be for income statement.
Or if we can meet earlier, I don't mind.
The thing is, we normally have Moyowa from 9 till 12.
Okay.
So there's between 12 and 3. That's the only other earlier time.
Okay, then we'll do maybe 2 to 5.
Okay, 2 to 5 works for me.
Yeah,
Any other person?
2 to 5 on Saturday. Every other person that wish to join can join. 2 to 5 or 2 to 4. Anytime we finish solving whatever question we want to solve, we end it.
Okay, great.
Yeah,
Thank you.
Yeah. Thank you very much, guys.
Yeah.
We'll see
Thank you.
you on Thursday. Please
thank you,
communicate
sir.
if you stumble on any issue when solving. Yeah.
Remember the reverse part of this question.
You said? Yeah, sure. I'm sending it right away.
Okay.
Yeah.
Thank you.
Thank you, Mr. Israel. Thank you.
Thank you, sir.